Have you ever imagined what it would be like to spot a financial disaster on the horizon before it wiped out your hard-earned savings? To have a solid plan ready while everyone else around you descends into chaos. That's precisely what Ray Dalio accomplished, not just once, but repeatedly over several decades. And today, I'm going to reveal how his approach can help you shield and even grow your wealth when it feels like the economy is falling to pieces. Before we dig into these insights, let me share a brief story. In 2008, the world plunged into the most severe financial crisis since the Great Depression. Banks went under. Millions lost their jobs, and entire countries seemed on the brink of collapse. But one investor saw it coming because he had been positioning himself for years. His name, Ray Dalio. Ray isn't your typical Wall Street executive. He founded Bridgewater Associates, now the largest hedge fund on the planet, and pioneered the concept that the economy behaves like a machine. In his view, elements like credit, interest rates, and employment move in patterns that can be read like clockwork. And if you learn to interpret these cycles, you can forecast market booms and downturns with astonishing precision. In this video, you'll uncover the essence of Dalio's playbook, his renowned principles for making clear-headed choices, and the debt cycle model he used to anticipate some of the biggest market meltdowns in recent history. This isn't some gimmicky way to get rich overnight. It's a practical guide to truly understanding economic forces, seeing how you can protect yourself before the next downturn strikes. The best part? You don't need a massive fortune or an Ivy League degree to start applying these concepts today. But first, have you ever wondered why the world's central banks, billionaires, and heads of state turn to Ray Dalio for advice? Stick around. In the next few minutes, you'll find out exactly why. To grasp how Ray Dalio became one of the most influential investors alive, you need to rewind to the key moments that shaped his path and the lessons he drew from both his biggest victories and his hardest failures. Because his story isn't one of sheer luck, it's the tale of someone who spent decades dissecting the patterns that drive markets, and who used those lessons to build one of history's most successful investment firms. Ray Dalio was born in 1949 in Queens, New York. His father was a jazz musician who played clarinet and saxophone in New York City clubs, while his mother stayed home to raise him. There was nothing particularly privileged about his childhood. He had no wealthy family ties, no private schools, and no early Wall Street connections. What he did have was an insatiable curiosity and a desire to understand how money worked. As a teenager, Dalio got his first real exposure to the financial world working as a golf caddy at a club frequented by Wall Street financiers. While carrying their clubs, he overheard them discussing stocks, which piqued his interest. And when the company announced a merger, the stock tripled, hooking young Ray on the idea that markets moved in patterns that, if understood, could yield profit. One day, he decided to try investing himself. He spent $300 on Northeast Airlines. While other teens focused on sports or school events, Dalio immersed himself in annual reports and market data. Striving to link economic developments with price movements, he was determined to decode what made markets move. By the time he finished high school, he was certain he wanted to dedicate his life to studying markets. Dalio earned his finance degree from Long Island University, then went on to get his MBA at Harvard Business School. There, he developed a reputation for challenging conventional thinking, both professors and peers, about how economies function. After graduation, he worked as a trader at Dominick & Dominick LLC, and later at Shearson Hayden Stone, where he laid the groundwork for his investment philosophy. But his real journey took off in 1975 when he launched Bridgewater Associates from his small New York City apartment. In the early days, Bridgewater was a modest operation. Dalio wrote daily economic updates for corporate clients. One of his first big contracts came from McDonald's, which needed guidance on managing currency risks as it expanded internationally. Dalio's thorough analysis impressed them, and word spread quickly about his unique perspective on markets. This research service would become the seed of what is now the world's largest hedge fund, but Dalio's path wasn't free of setbacks. In 1982, he was convinced the U.S. was about to experience a second Great Depression and made large, bearish bets accordingly. Certain of his forecast, he even debated top economists publicly. But when the economy staged a strong recovery instead, his positions collapsed, wiping him out. He had to let go of his staff and borrow from his father just to stay afloat. This humiliating misstep could have ended his career. Instead, it sparked his greatest breakthrough. He realized intelligence alone was on. He and nephew needed a system to challenge assumptions, refine your thinking, and manage risk rationally. From this, he began to craft his famous principles, a framework for making objective decisions, learning from mistakes, and staying grounded under pressure. Dalio also instilled a culture of radical honesty at Bridgewater. He encouraged team members to challenge each other's ideas openly, to learn from every error, and to record meetings for full transparency. This practice helped Bridgewater stay flexible and avoid herd mentality when markets shifted. As his methods evolved, so did Bridgewater's reputation. Big investors like pension funds and sovereign wealth funds began entrusting their money to Dalio's firm. By the 1990s, Bridgewater's flagship fund, Pure Alpha, was regularly outperforming the broader market with double-digit returns. Dalio's status as an economic guru was solidified when he correctly foresaw the 2008 crash. He had been sounding the alarm for years about dangerous levels of household debt and reckless lending. When the housing bubble burst, Bridgewater's funds soared while major banks crumbled, cementing his reputation as a master of economic cycles. But Dalio didn't keep his methods locked away. He shared his findings in writings and best-selling books like Principles, Life and Work, and Principles for Navigating Big Debt Crises. And he created a popular animated video explaining his economic machine theory, now viewed by millions worldwide. Today, Bridgewater oversees over $150 billion in assets. And Dalio's counsel is sought by leaders and institutions globally. He has donated hundreds of millions to educational causes to spread financial literacy and understanding of how economies operate. Dalio's journey from a curious teenager caddying on golf courses to a billionaire investor wasn't built on luck but on relentless learning, humility, and a commitment to systematic thinking that questioned traditional economic dogmas. But how did he turn these insights into a process capable of forecasting crises years in advance? And how can you use the same ideas to safeguard your finances? In the next part, I'll unpack his debt cycle framework and practical strategies, so you can start putting these powerful tools to work right away. Now that you've seen how Ray Dalio developed his understanding of economic cycles, it is time to explore the core of his method, the debt cycle, and the timeless principles he crafted to navigate unpredictable markets. These are the very concepts that enabled him to anticipate crises like the 2008 meltdown, and they can empower you to make wiser investment decisions as well. Dalio's pivotal insight is that economies don't shift at random. They move in discernible cycles shaped by human emotions, like greed and fear and the ongoing urge to borrow more than we can repay. By tracking these patterns, Dalio discovered you can spot when markets are overheating and when they're primed for bargains. He breaks debt cycles into two main types. Short-term debt cycles, usually lasting 5 to 8 years, which correspond to the familiar booms and recessions we see regularly. Long-term debt cycles, which can span 50 to 75 years and end in sweeping resets when debt burdens become unsustainable. Here's a simplified look at how these cycles unfold. As economies expand, companies borrow to grow, and consumers take on loans for homes, cars, and more. This creates a feedback loop. Increased spending fuels business profits. Businesses hire more workers, who in turn spend more, pushing asset prices up and making everyone feel wealthier. But sooner or later, debt rises faster than income. Borrowers start struggling with payments, defaults begin to climb, lenders pull back, and spending contracts. Corporate earnings drop, layoffs surge, and the economy slips into recession. In response, central banks typically cut interest rates to stimulate new borrowing, jump-starting the next short-term cycle. This boom-bust pattern repeats several times within each long-term debt cycle, gradually layering on more and more debt. Eventually, when interest rates reach rock bottom and can't go lower, central banks lose their most powerful tool. At that point, the economy faces a reckoning-a deleveraging period, which can end in one of three ways. 1. Harsh spending cuts, leading to severe recessions. 2. Debt write-offs or restructuring. 3. Massive monetary expansion, which risks igniting inflation or devaluing the currency. Dalio emphasizes that how governments and central banks choose among these options largely determines whether deleveraging is orderly or disastrous. By observing their actions, you can get crucial hints about what the economy will do next. To make these insights actionable, Dalio uses a set of rules he calls his principles guidelines for staying rational and objective when stakes are high. Here are three of his most impactful. Pain plus reflection equals progress. Dalio believes every failure or painful experience carries a lesson. He and his team dissect what went wrong, document their findings, and adjust their strategies to avoid repeating mistakes, a major factor in Bridgewater's resilience. Radical truth and radical transparency at Bridgewater. Employees are expected to speak honestly and challenge ideas, not people. Discussions are recorded so decisions can be reviewed, and colleagues score each other. Reasoning in real time, creating an environment where the strongest ideas rise to the top. Believability-weighted decisions. Dalio's team doesn't simply vote or defer to seniority. Instead, individuals' input is weighted based on their track record and expertise in a given area. So those with demonstrated success in a topic carry more influence when related decisions arise. These principles helped Bridgewater dodge many pitfalls that trip up traditional firms like groupthink or decisions driven by hierarchy rather than evidence. Want to see Dalio's ideas in action? In the early 2000s, he watched as household debt-to-income ratios hit alarming highs. He noticed adjustable-rate mortgages being approved for borrowers who clearly couldn't handle rising payments. Using his debt cycle analysis, he concluded the U.S. was not only topping a short-term debt cycle, but nearing the climax of a long-term one. While many pundits claimed the economy was robust, Dalio cautioned clients about an impending crisis. When the housing bubble burst in 2008, Bridgewater's funds booked significant gains, while many top financial firms went under. Proof his debt cycle wasn't just theory, but a powerful practical tool. Another cornerstone of Dalio's approach is his all-weather portfolio and investment mix, designed to deliver solid performance through any economic backdrop. He realized most portfolios are built assuming the future will mirror the recent past. But market shocks, whether driven by inflation or recessions, can devastate one-sided portfolios. Dalio's all-weather portfolio includes a carefully chosen combination of assets that respond differently depending on economic conditions. Stocks thrive during periods of growth with low inflation. Long-term bonds perform well when the economy contracts with low inflation. Commodities and gold protect against rising inflation. Diversification cushions against surprises in any scenario. His research showed this balanced approach could dramatically reduce volatility and large losses, while maintaining strong long-term returns, demonstrating the power of thoughtful diversification over blind bets. But how can you implement these ideas if you don't control billions like Dalio? In the next segment, I'll guide you through building your own all-weather portfolio, tracking where we are in the debt cycle, and making smarter investment moves, whether the economy grows or contracts. Now that you understand the essence of Ray Dalio's approach, reading economic cycles and crafting strategies designed to withstand any environment, it is time to put these ideas into practice so you can start safeguarding your own finances today, no matter the size of your portfolio. The beauty of Dalio's framework is that it isn't just 4 billionaires or financial professionals, a mindset that anyone can adopt. So let's start by building your personal version of the all-weather portfolio. But to be prepared for every possibility, whether that's robust growth, a sharp recession, rising inflation, or even deflation. Remember, the goal isn't to guess what the economy will do next. A straightforward allocation for US-based investors could look like this: 30% in stocks. Consider a broad index fund like SPY or VU to gain exposure to the overall US stock market. 40% in long-term bonds. ETFs such as TLT, which holds long-duration US Treasuries, tend to perform well when the economy slows or deflationary forces take hold. 15% in gold. Funds like GLD or physical gold can serve as a hedge when inflation heats up or currencies weaken. 15% in commodities. A diversified commodities ETF like DBC offers exposure to raw materials, which can thrive when prices rise broadly across the economy. This balanced mix helps you avoid putting all your eggs in one basket, reducing the risk of big losses if the economy shifts in unexpected ways. But knowing when to tweak your portfolio is just as important as building it in the first place. That's where Dalio's debt cycle analysis comes in handy. By tracking a few key economic indicators, you can stay alert to where we stand in both short and long-term cycles. Some of the most telling signs to watch include debt-to-income ratios. If debt levels are climbing faster than incomes, it could signal the economy is overheating and nearing a short-term peak. Interest rates. Extended periods of ultra-low rates often suggest the endgame of a long-term debt cycle, where central banks have limited tools left to stimulate growth. Inflation trends. Accelerating inflation can erode the value of bonds and cash, making real assets like commodities and gold more attractive. You don't need to be an economist to keep tabs on these metrics. Free resources like the Federal Reserve's Fed database, the Bureau of Economic Analysis, or financial news sites like Bloomberg and CNBC provide up-to-date charts and explanations. Checking them a few times a year is enough to make sure your portfolio still matches the current economic landscape. Another actionable tip from Dalio's playbook is backtesting you. It's a process where you simulate how your portfolio would have performed during past market events to see how it might hold up in future crises. You can use tools like Portfolio Visualizer or basic Excel spreadsheets to do this yourself. For instance, gather monthly price data for your selected ETFs. Run a historical simulation covering periods like the 2008 financial crash or the 2020 COVID market panic. Evaluate whether your portfolio would have experienced drawdowns beyond your comfort level and adjust your allocations if needed. But above all, remember one of Dalio's most powerful lessons. Don't let fear or greed dictate your decisions. If markets tumble and the headlines scream crisis, your diversified portfolio is specifically designed to help you weather the storm. Panic selling will only lock in losses, while sticking to your well-thought-out plan gives your strategy a chance to do what it was built for. One practical way to keep emotions in check is by maintaining an investment journal. Every time you make a decision, whether buying, selling, or rebalancing, write down what led you to act, what you were feeling, and which indicators you considered. Over time, reviewing your journal will reveal patterns in your thinking that lead to good outcomes or costly mistakes. This reflective habit embodies Dalio's principle that pain plus reflection equals progress. Even if you're investing solo, you can borrow from Bridgewater's radical transparency idea. Share your strategies and thought process with a trusted friend or mentor. Ask them to challenge your assumptions. Explaining your reasoning out loud forces you to think more clearly and can expose blind spots you might not notice alone. And don't be afraid to start small. Many modern brokerages allow you to buy fractional shares, so you can begin building your all-weather portfolio with just $50 or $100, then add gradually as you gain confidence and experience. By combining strategic diversification with a clear-eyed view of where we stand in the economic cycle, You'll be far better prepared than most investors who chase hot stocks or act on impulse. You won't be able to predict every twist or turn, but you'll have a framework designed to adapt to whatever the future brings. Now that you know how to set up your own diversified portfolio and monitor the debt cycle, let's explore how Dalio's model pinpointed the 2008 financial meltdown, and what the same indicators might be signaling about the risks facing the global economy today. In the mid-2000s, Ray Dalio carefully tracked U.S. household debt as it ballooned to unprecedented levels. He noticed mortgage lenders handing out adjustable-rate loans to borrowers who had little chance of paying once rates rose. Dalio's debt cycle analysis suggested the economy was not just topping out on a short-term cycle, but approaching the dangerous end of a long-term cycle. He warned that once home prices stopped rising, defaults would explode, sending ripples through the entire financial system. Many experts and policymakers insisted the economy was on solid ground. But when the housing market finally cracked in 2007, Dalio's predictions began to unfold. By 2008, as banks failed and markets tanked, Bridgewater's strategies delivered large gains while many institutions crumbled under the weight of bad loans and frozen credit markets. Dalio's accurate forecast wasn't luck. It was the result of a systematic reading of debt dynamics and human behavior at scale. But what about now? If you look closely, you'll find worrying parallels today. Record debt levels, both government and corporate debts, have soared in the wake of years of easy money policies. Historic low interest rates, central banks kept rates near zero for so long that they have little room left to cut when the next downturn arrives. Inflation pressures after decades of low inflation. Surging prices are now threatening to destabilize economies around the world, putting central banks in a bind between fighting inflation and supporting growth. According to Dalio's framework, these factors could indicate we're nearing the late stages of a long-term debt cycle, where traditional monetary tools lose their effectiveness and the risk of a disorderly deleveraging grows. So what can you do about it? Stay diversified. Relying on a single asset class like just stocks or just bonds leaves you vulnerable to the exact kind of shocks Dalio's model warns about. Regularly rebalance. As markets move, your portfolio can drift from its target mix. Periodic rebalancing restores your intended level of diversification. Watch key indicators. Keep an eye on debt growth relative to income, central bank policies, and inflation trends to get a sense of how late we are in the cycle. Maintain discipline. Avoid emotional decisions, especially during market panics or euphoric rallies. Your plan is your lifeline. Stick to it. By taking these steps, you'll position yourself not just to survive future crises, but to seize opportunities that often emerge when others are paralyzed by fear. Congratulations on sticking through to the end, because by learning these ideas, you're already ahead of most investors who never take time to understand how markets really work. You now know that the economy doesn't move chaotically, but in patterns driven by debt and human psychology patterns that can be read and used to your advantage. You've discovered Ray Dalio's debt cycle framework, his principles for rational thinking, and how to build an all-weather portfolio to prepare for whatever the future holds. Most importantly, you've learned that crises aren't just inevitable, they're opportunities for those who prepare. Here, something to ponder. The same debt cycle signals that warned Dalio of the 2008 collapse are flashing caution lights again today. With rising debt burdens, tricky inflation, and central banks stretched thin, could we be nearing another major reset? In my next video, I'll break down exactly how Dalio's model anticipated the last crisis and what it's telling us about 2024's economic landscape. I'll show you which indicators to watch, how to interpret them, and what concrete steps you can take now to protect your savings and even profit when others panic. So if you don't want to miss it, hit subscribe and turn on notifications so you'll be first to know when the new video goes live. And if you'd like a free checklist with Dalio's top principles to guide your investment strategy, leave a comment saying Dalio Principles. and I'll send it your way. If you found this video helpful, give it a thumbs up. It helps more people find this information. Share it with a friend who could benefit from understanding how markets really work. Remember, knowledge isn't power until you put it into action. Thanks for watching, and I'll see you in the next video where we'll go even deeper into anticipating and surviving the next big financial storm. Subscribe and turn on notifications for part 2. Want Dalio's principles? Comment Dalio principles below. Like, share, subscribe.